You're watching the Daily Market Comment by Mario Sachikiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. Bets that the Federal Reserve will raise interest rates this month receded yesterday after a couple of FOMC members signaled they would rather skip a rate increase. However, they stressed that skipping a rate hike this month does not necessarily mean interest rates have peaked for the cycle. It would simply allow policymakers extra time to examine incoming data before making any decisions, effectively keeping the door wide open for another hike in July. These cautious remarks knocked the wind out of the US dollar, which was flying high earlier in the session following some encouraging JOLTS employment data. Looking ahead, with Fed officials and investors split on whether another rate increase is on the menu in 2 weeks, there will be increased emphasis on economic data to settle the debate. The show will kick off today with the ISM Manufacturing Survey and the ADP Jobs Print, which will serve as appetizers for tomorrow's official employment report. In the political sphere, the House of Representatives overwhelmingly approved the deal to raise the debt ceiling in a vote yesterday, dispelling fears of a government default. The bill will now head to the Senate before President Biden can sign it into law. Markets did not react much, and gold was little changed near the $1,955 an ounce zone, kept afloat by the Fed-induced pullback in the dollar and yields. In the near term, the yellow metal's fortunes are linked to whether the FOMC will raise rates this month. Stock markets declined yesterday, with the S&P 500 losing 0.6% of its value to fall back below the crucial 4,200 region. It seems that the astonishing rally in tech stocks has started to fatigue, and things could get dicier over the summer in an environment of tighter liquidity conditions, expensive valuations, and stagnant earnings growth. In the euro area, the latest inflation stats will hit the markets today. Estimates suggest core inflation cooled only marginally in May, but most of the country-level reports so far have come in way below forecasts, posing some downside risks. A surprisingly soft inflation report could push back against market bets that the European Central Bank will raise interest rates another 2 times this summer, keeping the euro under selling pressure. From a chart perspective, the line in the sand for euro-dollar is the 105.20 area, where a downside valuation would mark a lower low and signal that the longer-term uptrend is no longer in play. Thank you for watching the Daily Market Comment here at XM.com.